Imagine trying to test a next-generation microchip, right? But it generates so much heat, it could literally melt its own internal architecture.
Oh yeah, it's a massive problem right now.
Right. I mean, you have these highly advanced graphics processing units, the GPUs powering all these large language models and AI data centers, and they're drawing just unprecedented amounts of power.
We're talking thermal design power pushing well past 1,000 watts for just a single piece of silicon.
Exactly. When you draw that much current, the chip basically becomes a miniature furnace.
Yeah, it really does.
And before that silicon ever makes it into a server rack, the manufacturer has to test it. They have to push it to its absolute limits to guarantee it won't fail in the field.
Which brings up a fundamental physics problem. How do you run a processor at maximum capacity without, completely destroying a die worth tens of thousands of dollars?
Right. And solving that specific high-stakes engineering bottleneck, it just triggered a massive 38% revenue spike for a semiconductor equipment company called Cohu.
Yeah, the physics of high-performance computing, or HPC, have basically created an absolute wall for legacy testing equipment, and Cohu has, they've essentially built the door to get through it.
So, welcome to this specialized Talk Tickers edition of the Deep Dive. We're pointing our usual analytical framework directly at the raw, unscripted data from Cohu's Q2 2026 earnings call. That's ticker symbol COHU.
And our mandate today is strict. We are staying relentlessly data forward, pulling the exact figures management presented to Wall Street.
Yep. We're going to break down all that complex engineering and financial jargon into clear, plain language.
And we're taking a firm, opinionated stance on what these numbers actually mean for the business.
Because most importantly, we're focused on actionable takeaways for you, the retail investor listening to this.
Yep.
So let's just jump right in.
Let's do it.
We have to start at the foundation to figure out if this company is a buy, a hold, or just a value trap. We need to look at the Q2 2026 headline numbers.
Right, because when a company in heavy capital equipment reports a massive jump like this, it usually signals that something structural is shifting in the macro environment.
Totally. So Cohu reported Q2 revenue of $149 million.
Which is huge.
It's a 38% year-over-year increase. And critically, they beat the midpoint of their own internal guidance. I mean, a 38% jump in hardware, that's not a minor fluctuation.
No, not at all. It requires a tremendous amount of supply chain coordination, factory optimization, and just, outright demand.
But bringing top-line revenue in the door is really only half the battle in the semiconductor space.
Right. The real story usually hides further down the income statement. The top line is impressive, but the profitability metrics are what actually change valuation models.
So what did those look like?
Well, Cohu posted a non-GAAP gross margin of 45.5% for the quarter.
Wow.
Yeah, and they explicitly noted this exceeded their guidance due to a highly favorable product mix. We also saw non-GAAP earnings per share land at 26 cents, alongside an adjusted EBITDA margin of 12%.
Okay, and what about the balance sheet? Because that's critical for a company self-funding these massive R&D cycles.
They're sitting on $498 million in cash and investments.
That's a solid war chest.
It is. And that cash pile actually grew by $9 million sequentially from Q1. So their operations are generating free cash flow even while they're scaling up manufacturing.
I really want to zero in on that 45.5% gross margin figure, though, because for anyone familiar with manufacturing, that is an incredibly difficult number to achieve and sustain.
Oh, absolutely.
Like when you're building enterprise software, hitting 80% margins makes sense. The marginal cost of duplicating code is practically zero.
Right.
But Cohu is building massive precision-engineered robotics. They're buying raw steel, specialized copper, precise motors, vision systems.
Right. Their bill of materials, the raw cost of the physical components is inherently high. Exactly. So to clear a 45.5% margin after accounting for materials and direct labor, hitting 45.5% margins in hardware is like a restaurant suddenly finding a way to make their signature steaks 10% cheaper to produce without losing any quality. How exactly did they pull that off?
It means they possess incredible pricing power. They are charging a massive premium.
And people are just paying it.
Yeah, because that pricing power is directly tied to the cost of failure for their customers.
Make that real for me.
Think about it. When a company is manufacturing advanced AI chips, the cost of a false positive during testing, like passing a bad chip that later fails in a data center, is catastrophic for their reputation.
Oh, for sure.
And conversely, a false negative, where you throw away a perfectly good $30,000 GPU just because your testing equipment couldn't maintain the right temperature, that's a direct massive massive hit to the manufacturer's profit margin.
So they're paying a premium for certainty. Exactly. Cohu commands that 45.5% gross margin because their equipment effectively guarantees the yield for these wildly expensive components. They aren't just selling metal, they're selling yield protection.
So the product mix shifting favorably basically means they're selling more of their highest margin, most advanced machines right now, which brings us to the story behind the data.
Right. The undisputed engine of this 38% revenue beat is the AI and high-performance computing boom.
And there was one specific machine that kept coming up in the transcript, right?
Yeah, their Eclipse thermal test handler. It's the crown jewel of their portfolio right now.
Why is it such a big deal?
Well, to understand why it's driving 150% year-over-year growth in their computing segment orders, we have to look at the mechanics of thermal testing.
Okay, let's break that down.
When an AI processor is placed into a test socket, it doesn't just passively run a few lines of code. The testing equipment slams it with complex, high-stress vector patterns.
Just lighting up every single transistor on the die all at once. Yeah.
Exactly. And the temperature of that silicon can spike from room temperature to over 100 degrees Celsius in just milliseconds.
It's essentially a controlled thermal explosion. I mean, if you just let it sit there in the open air, the chip would literally cook itself before the test even finished.
Right. You need a way to actively pull that heat away the instant it's generated.
And that's what Eclipse does.
Yeah, through a process called active temperature control, or ATC. And it's not just blowing cold air on a chip.
What's the actual mechanism?
The Eclipse handler physically presses this highly engineered thermal head, called a thermal, chuck directly onto the exposed silicon or the heat splitter of the processor.
Okay.
And this thermal head has liquid cooling fluid pumping through microscopic channels inside of it. As the chip spikes in temperature, the handler's sensors detect it in real time and instantaneously adjust the flow and temperature of the liquid coolant.
Wow. So it's actively fighting the heat.
Exactly. If the test requires the chip to be held at exactly 90 degrees Celsius to simulate a heavy server load, the Eclipse system dynamically fights the heat to keep it at 90 degrees. Not 89, not 91.
It's like stress testing a jet engine in a wind tunnel while precisely blasting it with liquid nitrogen to keep the exhaust from melting the testing rig.
That is a perfect analogy.
The engineering tolerances have to be microscopic. If that thermal head doesn't make absolutely perfect flush physical contact with the chip, you get a hot spot and the chip degrades.
We're talking tolerances measured in microns, maintaining perfectly uniform pressure across a silicon die that might be the size of a postage stamp.
All while it's expanding and contracting from thermal shock.
Exactly. And CEO Luis Antonio Miller pointed out on the call that computing segment orders now make up 46% of their total system orders.
So almost half of their entire hardware business is dedicated to solving this one specific physics problem for the AI industry.
Yep. But it isn't just the processors themselves generating demand. The transcript also highlighted incredibly strong shipments for inspection systems dealing with high bandwidth memory, or HBM.
Right, because whenever we talk about the AI boom, the media focuses almost entirely on GPUs. Like NVIDIA gets all the headlines.
Oh, where?
But the memory architecture supporting those GPUs is going through this radical shift, and it presents a completely different manufacturing nightmare.
High bandwidth memory is fundamentally changing semiconductor packaging. Historically, computer memory was planar.
Like a flat circuit board.
Right. You laid out individual DRAM chips next to each other, kind of like houses on a suburban street. Data had to travel out of the processor, down the street, and into the memory chip.
Which is fine for normal computing. But for AI training, where you're moving terabytes of data every second, that physical distance creates unacceptable latency.
And it consumes way too much power. The speed of light literally becomes a bottleneck.
So the industry solution was to build skyscrapers instead of suburbs. They started stacking the memory chips directly on top of each other.
Precisely. HBM takes multiple ultra-thin DRAM dies, sometimes 8, 12, or even 16 layers deep, and stacks them vertically in 3D space.
How do they even connect those layers?
They drill microscopic holes vertically through the silicon layers, known as through-silicon vias, or TSVs, and fill those holes with copper. Then they place this whole 3D memory tower on an interposer right next to the AI processor.
So you get massive parallel data transfer at super low power.
Exactly. But the manufacturing complexity is just staggering.
Because if you have a 12-layer stack of memory, and And the 11th layer has a microscopic defect in one of its copper vias.
The entire stack is useless.
You can't just unglue it and swap out the bad layer. You have to throw away the whole tower.
And that is exactly where Cohu comes in. They shipped final inspection systems specifically for HBM3, HBM4, and the upcoming HBM4E devices to a major US-based IDM during the second quarter.
What do these machines actually look for?
They use advanced optical and infrared vision systems to inspect the structural integrity of these 3D stacks. They make sure the microbumps and vias are perfectly aligned before they're permanently bonded to the processors.
As they move to HBM4E, those connections are getting exponentially smaller.
Much smaller and closer together, which makes Cohu's high-precision equipment even more critical. They are deeply embedded in the most technically demanding segments of the supply chain.
Okay, so we've got this massive AI and memory tailwind, but there was another key phrase in the earnings call that points to a broader macro shift.
You're talking about the utilization number.
Right. CEO Luis Mueller stated that semiconductor test utilization improved sequentially to 80% at the end of the second quarter. And he didn't just mention it in passing, he called it a turning point.
He did.
So for a listener who doesn't spend their life modeling semiconductor CapEx cycles, why is that specific number, 80%, the magic threshold for a company like Cohu?
Well, test utilization is arguably the single most important leading indicator for capital equipment demand. It refers to overall equipment effectiveness, or OEE.
Okay.
When a fab reports 80% utilization, it means 80% of their existing fleet of testing machines is actively running chips. The other 20% is idle.
Yeah, to an outsider, 80% sounds like they still have plenty of excess capacity. Like if you own a trucking company and you have 100 trucks, but you only have freight for 80, you aren't going to go buy 20 brand new trucks. You just use the ones in the lot.
That logic works perfectly for trucks, but it completely falls apart in a semiconductor clean room.
Why is that?
Because in a highly advanced fab, 100% utilization is a physical impossibility. Testing equipment requires constant calibration. Handlers need preventative maintenance.
Right.
The contactors, the physical pins that touch the chips, they wear out and need replacing. And whenever a factory switches from running one type of chip to another, the test handler has to be physically reconfigured.
Which creates unavoidable downtime. So that missing 20% isn't excess capacity. It's the necessary breathing room required just to keep the factory functioning.
Exactly. Factory physics dictate that as utilization approaches that 80% threshold, wait times for batches of wafers begin to increase exponentially. It's known as the Kingman formula in queuing theory.
Oh, wow. Yeah.
So when a fab hits 80%, supply chain managers know they are essentially maxed out. If demand increases even slightly, the whole production line bottlenecks at the testing phase.
Which delays shipments of finished chips to customers.
Right. And because it takes months for Cohu to build, ship, and install a new handler, semiconductor companies are forced to pull the trigger on new CapEx the second they see that 80% utilization rate. They have to order ahead of the bottleneck.
It's basically a forced buying cycle. They don't have a choice if they want to hit their revenue targets.
Exactly. And Cohu noted that their strongest historical segments, computing and industrial, were both operating in the low 80s by the end of Q2.
And industrial orders alone grew 87% year over year, which management directly tied to this utilization tripwire being crossed.
And CFO Jeffrey Jones gave some vital context here. He pointed out that historically, when utilization crosses 80%, it kicks off a sustained equipment buying cycle that lasts for roughly 6 quarters.
6 quarters. That's a year and a half of highly predictable structural demand just because their customers ran out of factory floor capacity.
It's a massive luxury in corporate forecasting.
But what makes that runway even more lucrative is how Cohu monetizes the equipment after it's installed.
Right, the recurring revenue.
Yeah, it's easy to assume they just sell $1 million box of metal, recognize revenue, and walk away for 5 years. But in Q2, 53% of Cohu's total revenue was recurring. Over half of their income is subscription-like. How are they doing that with heavy industrial robotics?
They've built an incredibly sticky ecosystem of consumables, upgrades, and deeply integrated software. Let's look at the physical side first. Semiconductor life cycles are remarkably short. A new iteration of a processor might drop every 12 to 18 months. And that new chip might have a slightly different footprint, pin layout, or thermal profile.
So when the customer transitions to making that new chip, do they need a brand new $1 million handler?
No, but they absolutely have to buy a new device application kit.
The physical interface layer.
Exactly. The customized tooling that lets the universal robot interact with the specific dimensions of the new chip. They have to buy new custom thermal heads. They have to buy new high-frequency contactors.
Those are the microscopic spring pins that actually connect with the chip, right?
Yeah, and those go through millions of physical actuations, pressing down over and over. Eventually, the mechanical springs fatigue or the gold plating wears off.
So they're a pure consumable.
Exactly. As long as the customer is running chips, they are forced to continuously buy these precision replacement parts from Cohu just to maintain their yield.
It's like every time Cohu sells a base machine, they're installing a permanent toll booth inside the customer's factory.
It really is. But the hardware consumables are only part of it now. The transcript highlighted this fascinating new software element. They're executing a land and expand strategy with their DI Core data analytics suite.
Tell me about DI Core.
This is where the recurring revenue model gets modernized. During the quarter, Cohu secured a subscription agreement with a leading HPC chip maker to deploy DI Core predictive maintenance across their entire test fleet.
What does the software actually do?
It sits on top of the physical equipment and monitors thousands of real-time telemetry points, vibration frequencies of the robotic arms, microscopic variations in thermal drift, the millisecond timing of the pick-and-place mechanisms.
So it's ingesting all this operational data and using AI to detect like subtle anomalies before a mechanical failure happens.
Yes. Instead of running a machine until a contactor snaps and ruins a batch of chips, or taking it offline prematurely for scheduled maintenance it doesn't need.
Right.
DI Core analyzes the degradation curve and tells the factory manager exactly when a component will fail days or weeks in advance.
So it transitions them from reactive to predictive maintenance.
Exactly. And by selling this software as a subscription, Cohu has created a high-margin recurring revenue stream that scales with the size of the customer's installed base. It fundamentally changes the valuation multiple you can apply to the stock.
Okay, I want to pivot here for a second. Because while AI computing is growing at 150%, and industrial is waking up with 87% growth, I'm looking at the automotive segment numbers in this transcript, and they are objectively terrible.
Yeah, they are.
Automotive revenue is down 24% year over year, and utilization in auto testing is stranded at roughly 77 to 78%.
Right.
We're talking about chips for EVs, advanced driver assistance, engine control units. If nearly a quarter of that market evaporated for Cohu over the last 12 months, are we ignoring a severe structural flaw just because the AI narrative is so shiny?
And that is exactly the critical lens a retail investor needs to apply. You can't just look at the high-growth segments and ignore the bleeding.
So why aren't institutional investors panicking about auto?
Because the context explains it. It's not a structural failure. It's a temporary cyclical misalignment. The automotive chip market operates on a completely different rhythm than the data center market.
Right. Auto chips aren't using the bleeding edge 3-nanometer processes that, NVIDIA or Apple use. They're built on mature legacy nodes.
And they prioritize extreme reliability over absolute performance. A failure in a car is a life or death scenario, whereas a failure in a data center is usually just a software reboot.
Right. Completely different risk profile.
And because they use legacy nodes, they fell victim to a massive inventory bullwhip effect.
Oh, from the supply chain crisis.
Exactly. A few years ago, automakers couldn't get chips, so they panicked. They double and triple ordered from foundries just to build a buffer.
And now supply chains are normal again.
Right. So automakers are sitting on massive stockpiles of inventory. They aren't ordering new chips because they're still burning through what they hoarded 2 years ago.
Which means the fabs aren't running as many automotive wafers, and test utilization drops to 77%.
Yep. It's just an inventory digestion phase. And because they're at 77%, they haven't crossed that 80% Kingman formula threshold. There's no bottleneck, so they have zero incentive to buy new machines from Cohu.
But the scale of the HPC and industrial boom is so overwhelming, it just absorbs that 24% drag.
Exactly. The company still grew top-line revenue by 38% overall. Plus, CEO Luis Mueller provided specific visibility into this. He said auto has been bouncing along the bottom, but he expects it to recover by late Q1 or Q2 of next year.
Because eventually the automakers will run out of those stockpiles. They'll have to order chips, the fabs will ramp up, and that 77% utilization will rapidly climb past 80%.
Triggering a massive wave of pent-up capital expenditure. It's essentially a coiled spring.
So when auto finally wakes up next year, it acts as a secondary booster rocket to their revenue.
Exactly. It's not a permanent impairment.
Which brings us perfectly to the guidance. We have the 80% utilization, trigger-pulled, structural AI demand, and a sticky recurring revenue model.
Right.
What is management actually telling Wall Street to expect for the rest of 2026?
The guidance is arguably the most aggressive and confident portion of the entire call. They formally raised their full year 2026 revenue growth outlook to approximately 35%.
Wow, raising full-year guidance by a full 10 percentage points, up from 25% halfway through the year. That's a massive flex.
It implies ironclad visibility into their order book for the next 6 months. You don't raise guidance that aggressively unless the purchase orders are literally sitting on the CFO's desk.
Because the penalty for missing a raised target is brutal on Wall Street.
Brutal. And looking at Q3 specifically, they guided revenue to $170 million plus or minus $7 million. Hitting the midpoint represents 14% sequential growth from this already massive Q2.
14% quarter over quarter for heavy manufacturing. That's phenomenal.
Yeah, it's a 35% growth compared to Q3 of the previous year. CFO Jeffrey Jones broke that down during the Q&A. He said the 14% sequential jump is split evenly, 50% from HPC orders ramping up, and 50% from the core industrial business reacting to that 80% utilization trigger.
It's a perfectly balanced growth profile. But there was one number disclosed that really stood out to me. The pipeline estimate for the HPC sector. Management officially raised their estimate of the HPC addressable opportunity to $850 million.
Yes.
But I want to stop and clarify this because Wall Street language can be so vague. When a company claims an $850 million pipeline, it's easy for a retail investor to assume that means total market size over, like, the next decade. If they mean over 10 years, we might see $850 million, that's pretty weak.
And an institutional analyst on the call had the exact same suspicion. They pushed CEO Mueller to clarify the time frame. Mueller's response was unequivocal. That $850 million represents the annual spend by their highly targeted specific customers.
Annual spend. Okay, that completely changes the math.
Right.
They aren't saying the total global addressable market is $850 million. They're saying the specific customers they are actively engaged with plan to spend $850 million on this exact type of equipment every single year.
Exactly. And if Cohu captures even a 30% or 40% market share of that pipeline, they're layering hundreds of millions in recurring high-margin revenue on top of their baseline.
And they gave a really granular breakdown of where that $850 million is in the sales funnel, didn't they?
They did. Because selling multi-million-dollar testing equipment isn't just swiping a credit card. It requires rigorous validation. So they divided the pipeline into 3 stages of maturity.
Let's walk through those stages, starting with the most secure bucket.
The first bucket is the qualified opportunity. This sits at $190 million annually, distributed across 4 specific customers. 3 in core HPC, 1 in high bandwidth memory.
What does qualified actually mean here?
It's the ultimate stamp of approval. It means Cohu's equipment has been physically installed in the customer's factory, run millions of test cycles on real silicon, and the customer's engineers verified it meets their exact specs for thermal control and reliability.
So for that $190 million, the intensive audits are totally finished. The machines are certified for high volume manufacturing.
Yep. So when these 4 customers need to expand, they don't even look at competitors. They just issue a purchase order to Cohu because the equipment is already written into their standard operating procedures. The friction to purchase is practically 0.
Got it. What's the second bucket?
Active qualification. This represents $250 million across 5 additional customers.
Okay, so they're currently testing the machines.
Exactly. The customer has accepted delivery of a Cohu machine, usually a custom beta unit, and it's sitting in their clean room. They are actively running statistical correlation studies.
Like head-to-head against their old equipment?
Yes. They're performing gauge R&R tests, repeatability and reproducibility to ensure the Cohu handler provides the exact same thermal environment and electrical interface as legacy equipment, just at higher power levels.
Because if the new handler introduces like electrical noise or thermal drift, it ruins the test data for the actual AI chip.
Exactly. It's a grueling technical audit. Mueller mentioned they're shipping final production configurations to one of these customers in late August, and they expect formal qualification within a month.
Wow, that's fast.
Another major customer is taking delivery of a highly complex thermal handler in August for a 6-month qualification. So that revenue stream will move into the qualified bucket by Q1 of next year.
It's a highly visible conveyor belt moving customers from testing to purchasing, which leaves the final and largest segment.
The third bucket is early stage engagement. representing $445 million across 10 additional customers.
Who are these customers?
These are the fabulous semiconductor companies, the massive hyperscalers, the cloud infrastructure providers, the ones increasingly designing their own custom AI silicon to escape their reliance on NVIDIA.
Oh, right.
Because they're designing entirely new chip architectures with crazy thermal profiles, they're engaging with Cohu's engineers years before the chips actually go into mass production.
They're collaborating on the blueprints.
Exactly. Designing the testing equipment in tandem with the chip itself, because the chip is so powerful, it literally cannot exist unless the testing infrastructure is invented simultaneously.
That's wild. So you take those three buckets, 190 million qualified, 250 million actively testing, and 445 million in early engagement, and you get an incredibly robust $850 million annual pipeline.
Exactly.
But this introduces a massive, undeniable logistical problem.
Oh, absolutely.
You just raised your full-year growth guidance to 35%. You have an $850 million pipeline rushing toward you. You're building hyper-complex robotics. How on earth do you physically build enough machines to satisfy that demand? You can't just hire temporary workers to assemble liquid-cooled thermal systems.
It is the central operational risk for the entire company, and management dedicated a big chunk of the call to their capacity expansion strategy.
What's the plan?
They're aggressively expanding their manufacturing footprint in Southeast Asia. They're currently fitting out new, highly advanced production floors at their primary facility in Malaysia.
And what's the timeline on that? Because building clean room robotics lines isn't fast.
It's an incredibly aggressive timeline. Their immediate goal is to double their manufacturing output capacity for these HPC handlers by the end of this calendar year.
Doubling factory output in 6 months.
Yeah.
That requires flawless execution. You have to double your raw materials, double your testing stations, double QA without letting defect rates slip.
And they aren't stopping there. By mid-2027, they plan to double it again.
Wait, really?
Yeah, they're essentially attempting to triple their global output of advanced thermal handlers in under 18 months.
That's insane.
Plus, they're doing a parallel expansion at their facility in the Philippines, specifically dedicated to machining the thermal heads and contactors, the high-margin consumables.
So they're scaling up razor production in Malaysia
Yeah.
and blade production in the Philippines simultaneously.
Exactly.
But hypergrowth always creates friction. You don't try to triple precision manufacturing without hitting constraints. What are the specific headwinds they're worried about?
CFO Jeffrey Jones was very transparent about this. The primary bottleneck isn't their own assembly capability, it's their upstream supply chain.
For raw materials.
Yeah. The explosion of AI demand is draining the global inventory of specialty electronic components. It's causing significantly longer lead times and higher input costs.
What components specifically? Because a handler is mostly like steel and cooling pumps.
Interestingly, the most severe bottleneck is semiconductor memory components.
Wait, memory?
Yeah. Even though Cohu builds the machines that test chips, the machines themselves require vast amounts of high-speed memory.
Oh, to store the test patterns.
Exactly. They use complex FPGAs and massive local memory buffers to store the billions of test vectors fired at the AI chip. Because the whole tech sector is hoarding memory for AI servers, the price and availability of these industrial-grade memory modules has become incredibly volatile.
So they're caught in the crossfire of the very AI boom they're profiting from. How are they dealing with it? Just waiting it out?
They can't wait. To protect delivery schedules, Cohu is aggressively utilizing advanced purchasing strategies. They're looking 3 to 4 quarters out and locking in massive bulk orders of these constrained components right now, effectively hoarding parts.
But there's a penalty for advanced purchasing in a constrained market.
Always. They're paying a significant premium to secure that inventory. They are voluntarily absorbing higher bill of material costs today to ensure they don't miss a delivery deadline tomorrow.
Does it work?
It's kept their lead times relatively steady at about 13 to 14 weeks from purchase order to delivery, but CFO Jones explicitly warned they're beginning delicate conversations with customers about passing those increased costs along.
The ultimate test of pricing power. If raw materials cost 15% more, can you raise the price of your machine by 15% without the customer canceling the order?
Exactly.
If they can't pass those costs along, that beautiful 45.5% gross margin we praised earlier is going to get compressed real fast.
It's the defining tension of their business model right now. But Cohu has massive leverage at the negotiating table.
How so?
Remember that $26 million order in early July? When a major chip maker commits $26 million because they believe your thermal tech is the only thing preventing their AI chips from melting, they are highly unlikely to abandon the order over a moderate price increase.
The switching costs are just too high. They're locked into the architecture.
Exactly.
Okay, so we've disassembled the headline data, the thermal physics, the pipeline, and the supply chain mechanics. It's time to synthesize this into actionable intelligence. Based on the totality of this earnings call, what is the bottom line for the retail investor?
The verdict derived from this data is unequivocally structurally bullish.
Walk me through the comprehensive thesis for that. Why a structural buy and not a short-term trade?
It rests on this rare intersection. Cohu is operating at the exact point where a traditional cyclical recovery collides with an unprecedented secular technological boom.
Okay, cyclical first.
On the cyclical side, they have the ultimate safety net. Their core industrial and computing segments hit that mathematical 80% utilization threshold that automatically triggers a predictable multi-quarter CapEx cycle. They have a guaranteed baseline of highly profitable revenue locked in for the next 12 to 18 months just from routine factory expansion.
That's the bedrock. So what's the premium on top?
The AI hardware revolution. The demand for the Eclipse thermal handler isn't an inventory cycle. It's driven by the immutable laws of thermodynamics. As hyperscalers demand more compute, the silicon draws more power and generates exponentially more heat. Testing these chips requires active, liquid-cooled, micron-level precision that legacy equipment just can't provide.
Cohu engineered a specific solution to the most critical bottleneck in the AI supply chain. And the competitive moat around it seems huge.
It's a phenomenal moat. During the Q&A, CEO Mueller casually dropped a quote from a major unnamed Bay Area customer.
Wonder who that could be.
Right. And that customer told Cohu they possess the best thermal in the market. When the most demanding chip designers on the planet publicly acknowledge your architecture is the gold standard for solving their hardest physical constraints, your pricing power is robust.
And beyond the tech, there's that purely financial mechanism driving the bullishness, the operating leverage.
Yes, the financial architecture is primed for explosive profitability. Despite navigating this massive scale-up, they've held operating expenses flat at around $54 million a quarter.
So the core costs are fixed.
Exactly. Which means a massive percentage of every new dollar of HPC revenue drops directly to the bottom line. Management explicitly forecasted that 40% of their sequential revenue growth will convert directly into operating profit.
A 40% fall-through rate on incremental revenue is a dream scenario for hardware. Sounds like Cohu isn't out there panning for gold. They are selling the absolute best pickaxes to the miners who are, and they charge a subscription to keep those pickaxes sharp.
That is exactly what they're doing.
But we always have to look at the downside risks. For the listener holding shares or considering a position, what specific metrics do they need to ruthlessly monitor over the next 2 quarters? What are the failure points?
2 things. First is pure operational execution. They promise to double precision manufacturing capacity in Malaysia by year-end. If they miss that timeline or struggle to hire specialized engineers, that $850 million pipeline will bottleneck in their own factories and growth stalls.
Execution risk is paramount. What's the second?
Gross margin trajectory. We know they're absorbing higher memory component costs. If you look at the Q3 report and see that stellar 45.5% margin suddenly compressed to 41% or 42%, that's a massive red flag. It means supply chain inflation outpaced their ability to raise prices.
Meaning their moat isn't as impenetrable as they thought. So, watch capacity expansion in Malaysia and ruthlessly monitor the gross margin. If both hold steady, the tailwinds are immense. Well, we've executed our Talk Tickers mandate today. We analyzed the 38% top-line explosion, unpacked the intense thermal physics driving Eclipse, and detailed the operational mechanics behind the 80% utilization turning point.
We also stress-tested the 35% growth guidance, dissected the pipeline, and weighed the logistical challenges against the component supply chain.
But before we wrap, we always look for a subtle detail in the transcript that hints at a larger global trend. What did you find?
There was this really specific operational detail about their DI Core software. Management noted they are deploying the DI Core AI software directly on-site, using localized hardware appliances physically installed inside the customer's semiconductor factories.
Wait, so they're intentionally choosing not to run these advanced AI analytics in the cloud?
Exactly. And the rationale is profound. Semiconductor manufacturers operate under the strictest data sovereignty rules on the planet. The microscopic variations in their yield data, that's the literal blueprint of their competitive advantage.
They treat it like nuclear launch codes.
Exactly. They fundamentally refuse to transmit that telemetry out of their physical buildings into a public cloud, like AWS or Azure. The theoretical security risk is just an unacceptable business proposition.
That is an incredible paradox. The companies building the very hardware that powers the public cloud refuse to use the public cloud for their own data.
It really makes you think. If the most advanced manufacturing facilities in the world refuse to utilize public cloud infrastructure for AI analytics, what does that mean for the ultimate growth ceiling of those centralized cloud providers?
As global heavy industry becomes more automated, are we going to see a massive shift toward localized, air-gapped, on-premise AI appliances?
Just to satisfy data sovereignty requirements, it's a trend that could completely rewrite enterprise software valuations over the next decade.
That's something to mull over. The reality of data sovereignty and on-premise computing might just be the truth that the massive cloud providers do not want the market to fully understand yet. So keep questioning the data, keep looking for the physical mechanisms driving the numbers, and we'll be back next time for another deep dive.